Hello everyone, and welcome back to Dr. Tao's Quant Lab. Over the last two lectures, we built the core of our training engine. Moving averages give us our direction. The MACD gives us our velocity. But if you trade long enough, you will realize both of those tools have a fatal flaw. They will destroy your account in a choppy, sideways market. To fix this, we need a mathematical filter that tells us, is this stock actually trending or is it just noise? Today, we complete the trend engine by mastering the DMI and the ADX. When you apply this to your chart, it generates lines based on a 14-day look-back period. If you use some trading apps, you will see the terms PDI and MDI. Let's look at the actual math. The PDI plus directional indicator isolates upward movement. It takes the difference between today's high and yesterday's high, smooths it out over 14 days, and divides it by the ATR, the average true range. What exactly is the ATR? It is the absolute measure of a stock's volatility. The algorithm calculates the true range by taking the maximum of three things: today's high minus low, the absolute distance from today's high to yesterday's close, or the absolute distance from today's low to yesterday's close. By running a maximum function across those three values, the math brilliantly accounts for overnight price gap that a simple high-low calculation would miss. The MDI minus directional indicator does the exact same thing, but it isolates downward movement, today's low versus yesterday's low. Because both are divided by the same volatility matrix, they engage in a constant mathematical tug-of-war. Whichever line is physically higher on your screen is the side that has control of the market. If the PDI is above the MDI, the bulls are actively pushing the ceiling higher. On the other hand, if the MDI is greater than the PDI, the bears is in control. But the real secret to this system is the third line, the ADX, or Average Directional Index. Look at the formula for the ADX. We take the absolute difference of the PDI and MDI and divide it by their sum. Mathematically, the difference between two positive numbers can never be larger than their sum. Therefore, the resulting fraction is always a decimal between 0 and 1. We multiply by 100, which permanently locks the ADX line inside a boundary of 0 to 100. It can never go higher, and it can never go lower. This brings us to the greatest misconception retail traders have. When amateur trades see the ADX line aggressively going up, they blindly assume the stock is going up. This is completely wrong. Because of that absolute value math, the ADX is no directional. It does not care if the stock is going up or down. It only measures the strength of the move. If a stock is having a violent market crash, the ADX line will spike straight up, because the strength of the downtrend is immense. Okay, some trading apps may provide another curve or line which is called ADXR, which is 6-day average of this ADX line. Since it is a smooth average of an already smooth line, it suffers from severe mathematical lag, so we can ignore this ADXR for future use. So how do we actually use the ADX? We use the ADX as the strict mathematical filter. If the ADX is below 20, the market is dead. The daily noise is greater than the signal. If you try to trade moving averages, crossover, or MACD crosses, while the ADX is below 20, you will get chopped to pieces. We veto those trades. When the ADX breaks above 25, a strong confirmed institutional trend is active. This is the green light. It is when our moving averages and MACD signals become highly reliable. And if the ADX pushes above 40, the trend is incredibly strong, but the mathematical rubber band is stretched to its absolute limit. We must be very careful about buying here because a mean reversion pullback is statistically imminent. Okay, so how do we apply this to our afternoon golden window? We use it as our ultimate veto authority. Let's say you see a beautiful MACD golden cross on your chart at 3:30 p.m., but you look down and the ADX is sitting at 14, you veto the trade. The market environment does not support momentum. We only deploy our capital when the ADX is rising past 20, and the PDI confirms the bulls are in control. Okay, so let's look at the real example for NVIDIA. Okay, so here's the daily K line for NVIDIA since July 2025. So to just look at, we can pull off this MACD and this this DMI. Okay, and we can make them larger to see clearly. So let's look at this MACD. So here, when we see a golden cross around June 25, so we will focus on this ADX and the position for PDI and MDI. So if we see this golden cross and if we look at this ADX, which is 54 something, right? So it is greater than 20. So this is a potential buying point. Remember that we want this ADX greater than 20, which indicates a trend or a very strong trend for this 54. And also we need this PDI, which is higher than the MDI, which means which is the going up trend. Okay, increasing trend. And then we move to the following. So if you look at this MACD right here, it's somehow a golden cross here, but and this ADX is 25. Okay, so you look at here for the ADX value, and also this golden cross is almost higher than the zero line here. So this is somehow a potential buying point, but since this PDI is lower than MDI, so you need to be very careful to look at to wait a little bit here. Okay, so it actually decreases for the stock price. And a golden cross here from MACD, and this ADX is 21 greater than 20. But again, this PDI is lower than the MDI, so we cannot buy it here. Let's move on to the next one. So here is another golden cross, and this ADX is 29. But this PDI is lower than the MDI, so we need to be a little bit careful for this buying point. And then another golden cross right here, and the PDI this ADX is lower than 20, so we cannot buy it. And you see here is a downtrend here. So let's move on to the next, the golden cross right here. The ADX is less than 20, so we need to be careful. And also this is lower than the zero line, so we cannot buy it here. And you see that this point here, there's no trend right here. So the ADX is pretty low here. And let's move on to the next golden cross here. The ADX less than 20, so it's not a buying point. And the next one here, the ADX is greater than 20, but the cross is not exactly above the zero line. So be careful for it is a potential buying point, but not a very strong signal. Okay, another somehow golden cross here, the ADX is less than 20, but uh, so it's not a buying point based on these two indicators. And the next one is here, it is lower than the zero line. So basically, it is not a good one from the MACD. Okay, so in summary, some of them are really good buying signals. For example, the first golden cross here. So we have a golden cross from the MACD, and higher ADX higher than 20, and also PDI is higher than this MDI. So this is a really good buying point based on these two indicators, and you can see a uptrend from here to here. Okay. All right. So the trend engine is now fully complete. We have direction, velocity, and strength. But these tools only analyze a single stock at a time. What if we want to measure the health of the entire stock market all at once? In our next chapter, we are zooming out to master macro breadth. See you in the quant lab.